Oh, yes, it is. 1/4% higher on whichever index you want to pick. 26 higher on the Nifty, 10,550. And on the Sensex, it's 35,030. That's about 80 points higher. So it's looking quiet. It's not too much of movement. But nevertheless, the movement that there is in the green. The mid-caps are a shade better. So let's read the green stocks first. Tata Motors is the one that leads the pack with 2% gain. And then is GAIL, which has got a thumbs up for the EBIT performance of its transmission lines. That's up about 2%. Yes Bank continues to tick higher, 1.3. HCL Tech, Sun Pharma, Bajaj Finserv. Okay, so it's a motley group of stocks that are 1% higher. But that ends the 1%er. And then comes stocks that are just barely in the green. That's Hero, TCS, M&M, Z, Tata Steel. All of them up about 0.5%. What's red? I think Vedanta definitely is in the red. That's because we've got kind of LME metals not doing too well. So you have Vedanta down about 4%. Cipla continues to get punished, 3.5% down. And UPL, Wipro, Asian Paints are marginally down. I mean, you can just see a red tick. The Bank Nifty has caught up now. It's in shoulder to shoulder with Nifty.
Okay, well, it's a good opening for the mid-cap index, up about 0.5%, almost a 100-point up move. The market breadth is solid, actually, more than 850 stocks on the advancing side. You have a lot of financials that are doing well. Indian Bank is up about 3-odd%. DHFL is up 5%. Muthoot Finance, so a lot of NBFCs, we were talking about that earlier, doing pretty well. If the liquidity window gets opened up, you never know how many of these could fare. Then, you have a couple of more stocks. VIP is up almost about 2-odd%. Godrej Agrovet is up about 1.5%. Some of these tire names like Apollo Tyres, etc. are in the green, up about 2-odd% there. Bajaj Finserv has also seen a bit of a recovery, so up about 1%. And Bandhan Bank, etc. are also moving with some strength. So that's the list of gainers. The screen is peppered with gainers from the NBFC space. So that perhaps is a trade today. Cipla is down 4%, post the cautious guidance from the management. Fortis Healthcare also under pressure. Jet Airways is down about 2-odd% or so. And a couple of these oil marketing companies are under a bit of pressure now. IOC down about 1%. But otherwise, it's actually quite a stable opening for the market. I mean, almost 50 points higher. Do you reckon this would sustain?
I think decent opening. I think Exide for me is the stock of the morning because it is bouncing back from yesterday's low, and once again the market perhaps focusing on the top line growth and the fact that the margin could actually pick up. The other one, of course, is Indian Bank. It looks like there's some kind of profit taking in SBI, and that money perhaps moving to some of the other PSU banks, the stronger ones like Indian Bank. But Exide for me really is the stock of the morning. Ashwini, your thoughts on market opening, and is there a trade here?
So the Bank Nifty is up 100 points and all banks are in the positive. So my sense is that range expansion is beginning on financials. Now, what is the reason? That, time will tell. But definitely chase Bank Nifty. It's crossing 25,900 on Bank Nifty futures. So that way, I think today we could have a bit of a financials day. Other than that, I think on the Nifty also you are up about 50 points. Again, if we cross 10,600, you'll get follow through. I don't think this looks like quite the Asian style opening. So my sense is that you could have upside, and this is the time to buy. 10,500 is your Nifty stop, and on the Bank Nifty, I think 100-point stop from here should work out.
Okay, well, Yes Bank is moving with some strength this morning, up almost about 1.5%. The chart will come up for you. In fact, this month, in just a few days of the month, Yes Bank has put on about 15% weight. So, Darshan, your thoughts on market opening first up, and also on Yes Bank, do you think it's hit a bottom at around that 180, 185 zone?
Yeah, again, we should be long in the Nifty and the Nifty Bank. I think Yes Bank has probably hit a bottom. It may go and try to test the lows maybe sometime if the Nifty falls. But this is a very good time to accumulate if you are an investor. I don't have a trading opinion on it. Maruti is a buy for the day. It should add to the Nifty gains.
Okay. Mitesh, your thoughts on Exide and any other individual stock that you liked?
Yeah, so Anuj, Exide is close to support range. I think it's doing 265 to about 245, 250 on the downside, and yesterday had a low of around 247. So it's at the support area. It's trying to bounce back. I think it should possibly head towards 265, 266 on the upside, the upper end of the range soon, and therefore it could be a good trading play for that point of view. That apart, I think I like Axis Bank and I like Eicher Motors. I think Bank Nifty, yes, remains strong for me, and both these stocks are also showing good expansion on the intraday hourly chart. So maybe some trading traction could be witnessed in these for the next 2 days.
So Darshan, would you be willing to touch any of the NBFC companies? They've had a volatile last few weeks.
Well, starting with Bajaj Finance, and there's a disclosure, I actually have positions in it, trading positions. But go with top class quality. M&M Finance and Bajaj Finance are probably the best.
For a long trade, of course.
For a long trade.
Okay.
Avoid the others.
Okay. Ashwini, would you trade any of them?
See, my only question to that is why do we have to trade in them? Last year was NBFC year. This year is a corporate bank year. So try to get into corporate banks. NBFCs will be, down 8% because somebody said something, up 6% because something else happened. So choppiness will probably happen. You have an odd Bajaj Finance, etc., but nothing really significant.
Actually, today the PSU banks, like all the chartists pointed out, are up and about. Dena, of course, is a penny stock, but that's up 9%. Andhra Bank, 6%. Again, penny stock, 25 rupees. UCO is up 6%. Again, penny stock. Indian Bank, 4.5%. Corporation Bank, 4.5%. Bank of Maharashtra, 2.5%. I mean, I could go on. All of them are up.
Some news on Indiabulls Housing Finance. It's issued 1,500 crores long-term bonds, including 10-year money. Lata, what would that mean?
No, it's very big, isn't it? I mean, clearly it shows trust that somebody has picked up a 10-year, I think it must be a debenture or a bond from Indiabulls Housing. And I think they've also been able to buy back some of their CPs.
Yeah.
Even DHFL did that early this week.
10-year? 10-year money is quite a bit, so that's asserting something.
Yeah.
And the buying back commercial paper, I think, is a show of strength. That if you guys think that you don't want to refinance it, I am buying it even ahead of time.
Okay.
So that's making a good statement.
The stock that's falling a lot now is SBI. Just pull out that intra-morning chart on SBI, and after that first green tick, that's getting sold into. And now making lows of the day down about 1.5%.
And the stock that's surging now is Tata Motors. I mean, 3.5% higher on Tata Motors. It's back close to that 200 rupee mark. I mean, surging is, I guess it's an exaggeration compared to the fall that we've seen over the last year. It's halved over the last year. So this move pales in comparison to that. But the UK registration numbers have been very strong. So it's responding to that. At this price, what would you do?
No, so again, Tata Motors, you don't talk about buying because we've been talking about buying it at all levels. But now is the time, I said, which could trigger a bout of short covering if this news flow continues to come through. And there's nothing in the management commentary that is alarming anymore. So I think Tata Motors should kind of rally beyond this.
All right, gentlemen, thanks a lot for taking us through the market opening. We'll, of course, keep coming back to our technical experts. Gautam Chowcharia, MD and Head of research at UBS is with us now. Gautam, hi, good morning. Thanks a lot for joining us. First of all, happy Diwali to you and your team. Nice to see you in Diwali attire. You're hoping that this somewhat is going to be better for the market. The second half of this, the last somewhat, was a bit treacherous.
Good morning, everyone, and happy Diwali to all of you and all the viewers. The hope is always there for Indian markets because the long-term story is very much intact for Indian macro as well as stock markets. But yes, our view is for now still not positive from a near-term perspective. The risk-reward is still unattractive. And the reason for that is very simple. We have seen the markets derate over the last few months. But the important change also is we have moved away from the easy money era of last 3-4 years in India locally to a tighter liquidity environment. And in that sense, we will see very difficult for markets to re-rate back up from current levels. So keeping the current valuation framework also doesn't make risk reward attractive, specifically given likely earnings cuts ahead for the markets.
Okay. Yeah, Gautam, good morning to you. And once again, happy Diwali from my end as well. The result season is almost behind us. Most of the big numbers are there. Now, what's the assessment of earnings growth this year?
So the first half results were expected to be optically good given the base effect from last year. But what we also do is look at the 2-year compounded growth rate for the first half and for the second quarter. And the compounded growth rate numbers doesn't look that exciting. It looks good for global commodities, oil, metals, etc. But for local economy facing companies, while the 1-year Y&Y numbers look optically good, but the 2-year compounded growth rates is more of a steady cycle rather than a big new upcycle per se. And this base effect will wear off for the second half this year. And also you remember that whatever liquidity tightness we have seen over the last couple of months, and in fact for the last 6 months, will have some follow-through impact on growth and earnings for second half. One of the work we had done earlier suggested nearly a third of the consumption growth over the last 3-4 years has been driven by leverage. And if you have seen that tightening, obviously it will have an impact on second half growth. So our top-down view is still 13% growth in earnings for Nifty for fiscal year March 19, which implies another 7%, 8% cut to street estimates. And 13% is not a pessimistic or conservative number. I'm building in some kind of optimism there. So we'll still see earnings cuts for fiscal year March 19, specifically to second half.
Okay, so earnings cuts going ahead as well. Gautam, hi, good morning. Happy Diwali to you from my end as well. I was going through your note and you say that your revised Nifty scenario implies that it is not yet time to buy on dips. Is the biggest risk, as you suggested, the earnings growth slowdown because of the liquidity squeeze, or are there any other risks on the horizon?
So as we've seen over the last 3-4 years, Indian markets have tended to ignore earnings momentum being negative and have cut. Despite earnings cuts, markets have done well, specifically given the outlook was good. And the two key drivers of that, beyond other factors, have been comfort and confidence around this government in terms of reforms agenda, and which made the outlook great from longer term perspective. And second has been local retail flows. Now, as we enter into 2019 election season, that uncertainty will become an overhang for market multiples, or will possibly cap markets to re-rate further, unless markets get confidence that this government is going to come back with a high level of confidence. Secondly, retail flows. We have seen the non-SIP part of retail flows dry up this year. And even SIPs, the second derivative has turned, in the sense that SIPs have stopped growing this year. They were growing every month for the last 4 years. This year they have stopped growing. And our analysis historically has been that 1-year trailing return is a good indicator of retail flows turning or accelerating. And we are at the cusp of that, where 1-year historical returns, at least on a large cap funds, are at those zone which is getting into negative zone. So if markets don't move up from here on, or correct 3-4% more from here, then even retail flows could be vulnerable, and could be the one last support for the market could also be missing.
Okay, that's interesting. Torrent Pharma, by the way, is interesting. That stock is surging now. I don't know if there's any news flow on that, but highest open interest gainer and quite a bit of price momentum is what you're seeing on Torrent Pharma, not Torrent Power, but Torrent Pharma. Just look at that, 3% higher on that stock. On that topic, Gautam, your thoughts on pharma? The couple of stocks like Divi's Labs, which have got their mojo back after that, horrendous last year. You reckon some more could follow that?
So overall, as a sector, we are still neutral from a portfolio positioning perspective. Pharma sector is much more about individual stocks than the broader sector. But yes, the big picture sectoral themes, the worst may be behind in terms of US generic pricing pressure. There is still pricing pressure, but nowhere as sharp as last 2-3 years. Even the FDA inspection, the worst is behind us. But what is still missing in general for the sector, except specific companies, is the outlook turning positive for US generics. If you look at last decade and a half, it's been the US generic growth which has been the key driver of these stocks doing well. And that turned 3 years back, and that is not looking like turning positively for the broader sector. Yes, select companies with specific models can do well, but a broader sector is still a neutral call for us.
Okay. I missed the exact number on earnings for the current year. What might it get corrected to, you said?
So my top-down forecast for fiscal year March 19 is 13%,
okay.
Which should imply a 7 to 8% cut in street estimates.
Okay, 7 to 8% earnings cut in street estimates. All right. Talking about more sectors, you continue to be overweight on private banks, especially the retail franchises. But now there seems to be a shift in focus towards the corporate banks because of the improvement in asset quality. Would you not want to sort of jump onto that bandwagon?
Absolutely, we have been overweight retail liability-driven corporate banks also. In fact, that's the most overweight call for us, and it's fairly consensus right now. Retail liability-driven corporate banks, so not wholesale-funded corporate banks, but those with retail liability. So when I say retail, it's primarily retail liability. So in the current tight liquidity environment, so last 3-4 years was an easy money period for India. NBFCs and wholesale-funded banks did well. Last 6 months and for the foreseeable future, it will be a tight liquid environment. So banks with the retail liability franchise will do well, both retail lenders as well as corporate lenders.
Are you all fishing in the troubled NBFC or HFC waters?
Top down, no. We're still underweight non-bank financials and wholesale funded banks. The reason being that this liquidity tightening which we are seeing beyond the short-term noise around credit crunch or a couple of defaults here and there, which I don't think will be a prolonged credit crunch any which way given the size of the problem. So I'm not worried about that. But what will not change is the tight liquidity. Unless oil crashes below $60 sustainably, liquidity is going to remain tight for India. And in that context, the NBFCs and wholesale funded banks still have more room for downside than upside at these valuations, because what we have seen in these stocks have corrected back from very, very high valuation levels to last 3, 4, 5 year averages. But again, last 3, 4 year, 5 year averages may not be the right benchmark, given that the last 3 to 5 years were an easy money period for these NBFCs.
Okay. What about L&T numbers? They were good, as were Cummins. Are you picking an industry trend from there and extrapolating buying more of capital goods, or are these specific to these stocks?
So again, very, very stock specific. Companies which are executing well or deleveraging, they could do well. But the broader capex cycle still remains muted in our view. We still are not believers in a uptick in capex cycle in a hurry. What we could get is a very mild capex uptick from very, very low base numbers over the next couple of years. But a proper upcycle in capex from the private sector, that seems very, very unlikely for us from our perspective over the next couple of years. So in a broad sense, the sector is still an underweight. Individual stocks with the right portfolio of orders or positioning can do well.
Okay, by the way, I just want to point out, Balkrishna Industries is now collapsing. It's down 7%. So obviously that's the negative earnings reaction. But you have a GAIL, which is now up about 2%. Just pull out that stock intraday, and it looks like that's the one which is now moving on. So GAIL is now at the highest point of the day, while Balkrishna is at the lowest point. And Cipla is the other one. Remember, after yesterday's 7% decline, there's another 3-4% decline on Cipla, which is on right now.
Oh, absolutely. Gautam, okay, in fact, on that note, we're going to thank you for joining us and giving us your view. So that's the word coming in from UBS India. You have a great Diwali and wishes to your team as well.